Traders, Coach T here and TackleTrading.com. It's Monday morning. Markets are about to open, and I was going through my regular checklist and kind of taking a look at our clubhouse and answering any questions I could. And I've got one here from Solene. Solene says, I'm curious to know what other tackle traders think of this trade and how they would have managed it. I placed this bull put spread on January 31st, thinking that the trend had reversed when it had broke above 142, the dotted line, which I guess is right here. And I watched the time decay bleed in my favor for almost 45 days. Today, the day before expiration, it broke below support resistance. I closed the trade before it hit my strike price. I technically didn't lose money, but with commissions I did. Do you see any blatant mistake I made when entering this trade? Is it just part of the numbers? Would you have managed it differently? It's a good question, Solene. Let's take a look. I love bull puts, by the way. LEA, Lear Corp, $140 stock. You played it back here in January on a retracement pivot rally, okay? And if I take a peek here, let me bring up a chart. Actually, I'm going to do this ThinkBack style. If I take it back to the date that you had identified, so you had the March 15, 140, 135. And based on your post, you told me it was on January 31st. So using the ThinkBack tool, I've got some interesting things I can do. I can come all the way back, ding ding, January 31st, and I can build the March 43-day option, 140, 19 delta. Good job on that. On the 31st, it was at 153. I want to double check your chart. Sure, that looks about right. So you had a $61 credit on those. Okay. And sell and buy 69. I'm going to change that to 0.63 to reflect your credit. There's your trade right there. Okay. And as I move the P&L forward, there's a couple things I can do. Number one is I can see how much money you would have made at different points. And I'm watching this number right here as I'm clicking the dates forward right here. Now, there you were down 30. As the chart went up and down, you were either up or down a little bit. That makes sense. Obviously, that's volatility of a bull put spread. You were up 33 at one point on the 16th. So you had made 50% of your credit right here. And you had been in the trade for 17 days. If we think about rules, I mean, some traders would take that profit right then. Others would not. It just depends on how you've designed your rules. Keep moving, 37, 44 bucks here. Now, when you've made 44 out of 63 potential, there was only 19 cents left on the 20th of February. Now, do you buy it back at 10 cents or 15 or a nickel? I would want to know what your specific rule is, because I don't know if you ever got back to that much profitability. Maybe 40, 37, NA on the first, second. There we are. Must have lost some data there for a few days. You had opportunities here. Even right here, you'd got to the point where you'd made $48 on 63, which means there was 15 cents of credit left on the 11th of March. And if I match that to what the charts were doing, just bring up LEA here. You did it post earnings. Your entry was right here. I like the entry. Earnings gap, bullish retracement, little doji candlestick. You got in on a good entry. Good confirmation candle. Trade developed up and down for a bit, never really ran for you or against you. Time decay was working, and then it turned on you here. By this time right here on the 11th of March, 6th of March broke down. Yeah, it was starting to sell there. Somebody could have made an argument that you should have done something here. But you're at support as well. Rules matter, you know. Now you're fighting the trend and hoping for expiration, and you're dealing with downside risk, and then boom, it gaps down on you. That was the 14th. Okay. So you go from the 12th, the 11th, and here. This is where we finished our think back, and then it really started to move against you. You go from profitability until you finally get out just on Friday. All right, let's take a look back at the ThinkBack. And then what that did here is move the 11th, 12th. On the 12th, you're up $50. There's only 13 cents credit, and you only had 3 days left. I'm not laughing at your pain. I'm laughing with you, my friend. I get it. Man, there's got to be a time where you just say, I've made enough of the potential credit. I'm going to avoid this gamma risk. Because when you get down to the end of option life, you have more gamma risk. As a matter of fact, at this point, and I'm going to move the expiration date forward too. Move this forward to March 12th. So Tuesday last week, extrinsic mark. Let's change this to an option theoretical. There's your gamma rate. See how the gamma rates are really high in these options? The further you go out in time, gamma's hardly anything. Like your at the money options were 9 and 4. That means the rate of delta is changing very, very quickly. In the Aprils, a month out, you're only a 3 gamma. In the June, later, you're only a 2 gamma. See, the closer you get to the expiration, the more sensitive the trade will be, especially when it's an at-the-money option. And as a credit trader, that's when this kind of stuff can happen. You know, the bottom line is, hindsight is 20/20, Solene, and it looks like you could have done this a little bit differently, but here's the advice I'm going to give you. Follow your rules, follow your rules. If we go to the tackle theta spreadsheet on tackle trading, and we go to the trade center, trade journals, and I look down here at your theta research journal. And it's down, tap a new copy, open it up, and let's review bull put spread. Bull put here. Your target rule was, there's a couple of them in here. Now this is bull put, 75% of the net liquidation. I actually have a lot of traders who they take profit at 50% of the net liquidation if they can capture it in the first 10 days. So you have to think about the return on time invested, ROTI, and you had a profitable trade. I don't think you necessarily made any mistakes because you just followed your design rule. But if I look at a calculator and really think about this, your 63-cent credit, if we multiply that by 50, you could have taken profit whenever you had $31 profit, okay? And there was many times you did that, but let's say that's not your rule. Say that you have a rule of 80% or 75%. 63-cent credit at a profit of 0.75, you could have taken profit when you had $47 profit. That would have been based on the rule in the tackle theta spreadsheet. So I think that there was an opportunity here, and the bigger opportunity instead of the one trade. We're talking about, one contract at $40, and I'm not trying to diminish the money, but learn from it and apply and build a better rule. It's the best advice I can give you. And also learn how to use your ThinkBack tool to kind of think through these trades in the past and go back and review them. All right, hopefully that helps. I don't think you did anything necessarily wrong, but I do think you should clarify your profit rule and also learn a little bit more about gamma rates. All right, get in the game. See ya. TackleTrading.com.